So a lot of my clients and agents, they've been asking me this question lately. Do you do a 2-1 buy down, 3-2-1 buy down, this, that buy down? And a lot of confusion around buy down. So if you want to know what the right buy down is for you, continue watching this video and let's clear some things up. Hey guys, your mortgage millennial Brian here. So we're going to talk a little bit about buy downs. And this is a simple rate buy down guide that I made for my clients and agent partners. If you want a copy, just DM me or email me and I can send you a PDF copy. But let's dive in and let's try to find what the right buy down is for you. Okay. Now, big categories, there's temporary and permanent. And we're going to walk through each category and kind of look at the different types of programs there are and see which one would be the best fit for you. So let's move on to temporary buy downs. Temporary buy downs, you're going to hear a lot about 2-1 buy downs, 3-2-1 buy downs, or 1-0 buy downs. And this simple concept is that, for example, if you're qualified at a 6% or a 6.5% rate, then for the first 2 years, you're going to pay 2% less, so at 4.5. And then the second year, you're going to pay 5.5% interest rate. Now, that difference between the qualifying rate and the actual rate that you're paying, that difference in interest payments is accredited from the seller. So we're asking for seller credit. Typically, a lot of builders do this. A lot of sellers now, buyers are asking sellers to do this now just because we're in a high interest rate environment. And it could be a really great program if you have a specific strategy. Okay. Let's talk about pros and cons about a temporary buy down. So a temporary buy down can seem really sexy. And what I mean by sexy is that, when your first year interest rate is only going to be 4%, 4.5%, wow, that monthly payment is going to be sweet. And then the second year, it only goes up by 1%. So you're at 5.5%. And then on the third year, you get to the full note rate, which is 6 or 6.5%, whatever you got qualified for. So it does look sexy, the lower rate. Any unused funds, if you do refinance before the full 3 years or 2 years or however you structure it, typically lenders will credit that back as a principal repayment. So it's a principal reduction payment. So typically, you don't lose that money. Now it just depends on lender to lender. I've had situations where certain lenders say that you forfeit that money. Some lenders will say that you do get credited that money and as a principal reduction payment. So con here. So a con is that you can't qualify at that lower rate. Okay. So if your par rate is, let's say, 7% and you want to do a 2-1 buy down, we can't qualify you at 5%. You have to still qualify at 7%. Okay. So that's the one thing. If you have really tight DTI margins, DTI ratios, this might be very difficult. So just be careful of that. Ask your lender, what your par rate is. Now, the second bullet point here is going to be only temporary relief in mortgage payments. Now, remember, it's just like the name, guys, it's temporary buy downs, which means that it's not going to last forever. So if you do a 2-1 buy down, that's a 2-year period where your interest payment is subsidized. So 3-2-1 is going to be a 3-year, 1-0 is just a 1-year period. Now, you need to have a strategy on what's going to happen after that second year is done, or that third year is done, or that first year is done. Like, what happens if you go back to your full note rate? Do you have an exit strategy? Do you have a strategy? A lot of lenders will say you can just refinance, but there is no guarantee that you would be able to refinance because, let's face it, we can't control some things in life. Life events happen, and knock on wood, but illness, death, loss of job, a lot of things can happen that may not qualify you for a refinance when that time comes, when the market dips and the rates dip. You got to be prepared, and you don't know if you're going to be prepared. Now, I will say, I'll give an example. For example, if you're a military family and you're going to PCS in 36 months or 24 months or however many months, and your time is finite and you're going to sell it anyway. That's a case where you do have a solid exit strategy. You got to sell, right? So in that case, I would highly recommend, I could highly recommend a 3-2-1 or a 2-1 buy down. But in most cases, me personally, I'm a huge fan of a permanent buy down over a uh, temporary buy down. And so let's look at, since I'm talking about permanent buy downs, let's look at what permanent buy downs are. So, a permanent buy down is not temporary, just as the name says, it's for the fixed term, meaning that it's for the life of the loan. So, once we lock into that um, bought down rate, you're going to have that rate for 360 payments. It's not going to change. It's not going to be variable. It's not going to be unpredictable. And that, that short amount of time isn't going to all of a sudden, come around the corner and surprise you because, time does fly. So, this is not a new concept, guys. It's been done for ages and in different cycles in the market in our history, like US real estate history. This has been a trend in multiple times. So it's not something new. It's something that, all lenders should know. But I'm going to be honest, not all lenders do know about it or can do it. And because there's some certain technicalities that we do have to be very careful about. So make sure that you know that your lender knows what they're doing. Not only that, but their operations team, their processors, their underwriters know what they're doing too. Because, one wrong thing and then the file could just collapse on itself. So let's take a look at pros and cons. So pros, the rate is fixed for the life of the loan, not going to change. The buyer can qualify at the lower rate because this is a permanent buy down using discount points. Once the rate is lowered or bought down, that is the qualifying rate. So let's say, 7% was your par rate. And with the permanent buy down, we were able to negotiate enough credit so that we can buy your interest rate down to, let's say, 5.5. Then we use 5.5% to qualify for your DTI and all that stuff. So, what does this bring to you? It avoids future refinancing issues. Okay. Like I talked about, job loss and, knock on wood, illness, death. There's a lot of things that can happen. But also, another thing that we don't really think about, especially in my market in Hawaii, our home values do tend to appreciate every single year, but that's not the case for markets in the mainland, right? So there are some markets like, Nevada, or, I'm just kind of saying some, random places, but where home values can drop 10% or 20%. And we've seen that happen in the 2008 and 9 and 10 housing crisis. So, what if your home value drops? Then we're not going to be able to refinance you because you're going to be upside down, as we call it. You're going to owe more on the house than the house is actually worth, and no lender is going to be able to refinance you out of your high interest rate mortgage at that point. So this does give you multiple layers of hedges so that it protects yourself. And that's why I'm a huge fan of the permanent buy down. And it's just a shame that not all lenders are really talking about this or trying to educate the buyers about a permanent buy down and how we can structure the deal so that we can get that permanent buy down for our clients. Yes, you can still refinance out of it. That's totally fine. It depends on if there's a seasoning period. Seasoning meaning that you have to wait like 6, 8, 12 months. Depending on the loan program, product, investor, there are going to be different requirements. So just be careful of that. Now, does it work for all loans? Yes, pretty much all loans. I do VA, FHA, ARMs, yes, conventional, and even jumbo. Now, for jumbo, you do have to be careful whether the investor allows it or not, but do talk to your lender about it and get educated. That's the most important thing. And also, for me personally, for my clients, I create a mortgage dashboard using an amazing program called Mortgage Coach and Lender Launchpad. So I love to show it visually, but a lot of the times I can just show it visually like this, and you can do a side-by-side cost analysis and comparison. So if you're one of my clients, or you want one of these, DM me or email me, call me, and I'll get it to you within 24 hours or so. Why am I doing this video? Because I think it's so important to bring back affordability into the conversation, especially when it comes to first-time home buyers, or maybe you're a repeat home buyer. But right now in this high interest rate environment, it's getting more and more tough for, just buying real estate. And so, I want to be creative. I want to bring creative solutions to the table and create that affordability for all my clients and all markets out there. So that's why I'm creating this video. If you liked what you saw, feel free to reach out to me. Here's my contact info if you don't have it already. But let's talk, let's connect, and then let's see what rate buy down is going to be best for you and your family, so that we can bring affordability, excuse me, back to the center of the conversation. All right, thanks for watching this far, guys. If you have any questions, let me know, and we'll see you soon. Take care.